Every day, trillions of dollars in global capital arc between continents in milliseconds. Liquid portfolio investments move with extreme speed. Foreign direct investment, or FDI, requires a different level of commitment. FDI is physical. It involves the transfer of fixed capital, heavy machinery, proprietary technology, and complex operations. Once a corporation pours concrete and builds a factory in another country, they cannot simply withdraw their assets if the market turns. This capital does not flow spontaneously, nor does it blindly chase the poorest countries with the cheapest available labor. FDI is a calculated maneuver, a physical anchoring of a firm's future into the structural and legal reality of a foreign jurisdiction. This physical transfer of capital only executes when two distinct global forces align. The first force consists of the source country push factors. These are the internal strategic pressures within a multinational firm: rising domestic costs, local market saturation, and the need to escape trade barriers. The second force comprises the host country pull factors. This is the macro-environmental reality of the target nation, generating its own gravitational pull through market size, raw materials, and economic stability. Capital remains stagnant until a specific push vector from the firm mathematically locks into a corresponding pull field of the host nation. Globalization is driven by corporate survival mechanisms that require highly specific international environments to function. To understand this mechanism, we have to look first at the perspective of a multinational enterprise operating inside a developed market. Successful firms eventually generate abundant capital, but they hit a wall of diminishing returns. Their domestic market reaches saturation, meaning each new local factory yields less profit than the last. To maintain returns, the firm must engage in international portfolio diversification, applying that concept to physical operations. Relying on a single national economy exposes a business to systematic risk. If a recession hits their home country, every revenue stream suffers simultaneously. Expanding operations into foreign markets insulates the firm. Because different national economies rarely experience business cycle downturns at the same time, overseas assets decouple the firm's overall cash flow from domestic fluctuations. Internal pressure and risk management act as an ejection seat, forcing the corporation to seek opportunities outside a tapped-out home market. The deployment strategy falls into distinct categories. In offensive FDI, a firm takes its proprietary technology and uses it to dominate a new, untapped foreign market. In defensive FDI, a firm deploys capital abroad specifically to match a rival. If a competitor establishes a foreign foothold, the firm builds its own local operations to prevent that rival from gaining an unassailable advantage in global scale. Friction also dictates strategy. Tariffs, quotas, and protectionist policies create massive logistical hurdles for standard exports. FDI acts as a direct bypass. By moving production inside the borders of the target market, the multinational steps inside the local trade environment, nullifying those restrictions. The trigger for this is often simple mathematics. When the cost of shipping a finished good exceeds the cost of operating a local production facility, the firm switches from exporting to FDI. Local production units function as both a tactical hedge against rival expansion and a bypass around a host nation's trade barriers. Evaluating these target nations brings us to pull factors, mapped out in the framework established by the United Nations Conference on Trade and Development, UNCTAD.
Before a corporate board runs the economic math on a potential host country, the target must pass the institutional premium test. Because FDI is irreversible, political stability and the rule of law are mandatory. A firm cannot sink $1 billion into a power grid if the legal system cannot protect property rights. The threat of nationalization, unpredictable bureaucracy, or deep-seated corruption introduces variables that cannot be priced into a financial model. Active socio-political resistance also matters. Severe ideological opposition or public hostility toward foreign capital can force firms to abandon projects that otherwise appear profitable. No amount of cheap labor or tax incentives can offset a failing institutional framework. If the political foundation is unstable, the capital will not land. If a country passes the institutional filter, the multinational evaluates the target through 3 economic paths: market seeking, resource seeking, and efficiency seeking. The first path is market seeking. A firm looks at the raw size of a population and its GDP per capita. Population size alone is irrelevant without sufficient per capita income. The host market needs an active consumer base with enough purchasing power to buy the firm's goods. The second path is resource and asset seeking. Resource seeking involves raw materials, but it also targets created assets. Multinationals look for established transportation hubs, reliable energy grids, and specialized research and development talent to fill their own structural gaps. Finally, we have the efficiency-seeking path, which focuses on labor costs. This path is often misunderstood. Efficiency is not a simple search for the lowest possible wage. The true metric is the wage-to-productivity ratio. Low wages offer no advantage if the workforce lacks the technical skills required to operate manufacturing machinery. Multinationals run a ruthless diagnostic to find the exact economic environment that fixes their specific strategic vulnerabilities. To attract these firms, host countries manipulate their macroeconomic conditions. Price stability is a strict baseline. High inflation destroys the real return on investment and makes operational planning impossible. Exchange rate dynamics also play a role. If a host nation's currency depreciates, it makes local labor and physical assets cheaper for foreign capital to acquire. When broader policies are insufficient, host nations deploy special economic zones to manually force pull-pull alignment. These zones are isolated areas where standard national bureaucracy is suspended. By offering zero customs duties and specialized infrastructure, governments build microenvironments of extreme efficiency. Developing nations use these zones as specialized docking bays, engineering the specific gravitational pull needed to catch a multinational's push vectors. Securing foreign direct investment requires continuous negotiation between corporate executives and state actors. For developing nations, FDI is not a passive entitlement granted for having a large population or rich resources. To become a viable target, a country must actively engineer its domestic policies, stabilize prices, and guarantee legal transparency. Capital requires a strategic match. The needs of a corporation looking to expand must align with the deliberate design of the host nation. In the global economy, institutional and macroeconomic stability is the ultimate currency, the only thing that can convert a corporation's need for scale into a host nation's economic development.